Well, welcome and thank you for joining us here today. I am Allison Moore, the Director of Client Relations and Marketing, and I work directly with our amazing team here at GenCrest to help bring you information that is helpful and relevant to the current market. Today, I have the pleasure of sitting down with Todd Walker. Todd is the Senior Portfolio Manager and is in the day-to-day management of our client portfolios. And today, we are going to talk about structured products and how they can help diversify our clients and set us apart at GenCrest from others. So Todd, let's talk all about structured products and how we're using them in our clients' portfolios today.
Okay, well, thanks, Allison. We use structured products in our clients' portfolio. What we're trying to do is we're trying to achieve a targeted income or growth levels while providing some measure of downside protection from market volatility. With the income notes, for example, we're trying to achieve above average monthly income with defined downside protection. In all of our strategies, our number one goal is to provide this downside protection. Once that piece has been achieved, we then ask ourselves, how much income can we generate with the amount of predetermined risk? We work with our investment banks to combine these concepts together, and typically we can provide 9 to 10% annualized income streams on the notes that we do. Now, the typical downside protection that we use is around 35%. We have looked at years of back testing to determine the percentage likelihood that any note will fall below the level of our downside protection. The testing and the structures that we have used show that the likelihood of any barrier breach is considerably less than 10%. Albeit we believe this is a low possibility of a breach with the structures that we use, we also ladder our portfolios with notes of different maturities. This laddering helps lower the overall risk levels for our clients to an even greater extent, though not entirely eliminating it.
So, knowing all that, who would you say structured products are actually for?
Well, the structured note portfolios that we create are designed for clients that we classify as sophisticated investors. The term doesn't come from the investor's market knowledge, but rather the goals and objective a specific investor has for their portfolio. For instance, above average growth with downside protection or above average income with downside protection. But due to the complex nature of structured products, they typically are only available through the use of financial advisors or through a firm like ours. And they also come with set minimum investments. At GenCrest, we not only have access to these types of products, but more importantly, we create our own notes and select the parameters for all the notes recommended in our client's portfolio. We have spent years developing our relationships with investment banks, and as a result, we have the ability to individually customize our structured products to fit our client's specific needs and risk levels that they're looking for. The overriding principle of our portfolio management is downside protection for our clients. Given our relationship with the banks and the size of the notes that we recommend, our structured products are designed with this principle in mind. And as a result, the use of structured products has helped us reduce the overall risk and volatility of our entire portfolio.
So I heard you mention that they're complex, and I'm a much more visual person, as I would say many are. Do you have any examples that you could go through to just kind of walk us through what each of them looks like?
Yes, let's take a minute to go through some specific examples. And let's just look at this first one as an example. We're going to talk about an income note first. As you can see, there are three different underliers: the S&P 500, the Russell 2000, and the Utilities Index. We do set a term, in this particular example is 36 months. And this particular note is callable after 6 months. So that means if it's trading for more than what you paid, it's going to get called. With the parameters that we've set up, we're able to get a coupon of 10% with 30% downside protection on the coupon and 35% downside protection on the principal. So let's look at a couple different market instances and see how this note reacts to each situation. And so as you can see in this particular instance, the note starts off with a price of $100. That's what we buy them by share. And then you can see that our downside protection, this is the green line, is 30% downside protection on the coupon and 35% downside protection on the overall note. And you can see at each of these quarterly call observations, the note is trading below what we paid for it and above the coupon barrier. So we get our coupon in each instance. So at the end, when this note matures, the client gets 100% of their principal back, and it gets 30% from the coupons over the 3 years. So they get a total of 130% total return of their investment. In the next instance, you can see that we paid the same 100. After 3 quarters, you can see that it's pricing above what we paid for it. So it will be called. In this example, we receive 3 quarters of interest for a return of 7.5%, and we get 100% of our principal back. So we get 107.5% total return on the investment. In the next scenario, you can see that in the quarter number 5, we fall below the coupon barrier of 70%. So for that particular coupon, we do not receive anything. And then the pricing goes back up, or the performance of the note improves, and we finish below what we paid for the note, but above our barriers when it matures. So at this point, when we've just missed 1 coupon payment, we've received 100% of the money back, 27.5% in coupon payments, for a total of 127.5% of our principal has been returned. In the next scenario, you can see the barriers breached a couple different times. And at the end, we fall below our protection level. So you can see in this particular instance, there's 4 quarters that we didn't get a coupon payment. So at the end, we get the 60% of the principal back because it's trading at the 60% level. We receive 20% in coupons, so we get a total of 80% of the total money back. And that's obviously a poor scenario for this particular note, and that's what we try to guard against. Now let's take a moment and look at the growth notes. And you can see in this growth note, we just work usually with one underlier. In this particular instance, it's the S&P 500. In a term, this is 3 years with a participation upside of 125% of the S&P 500 and a downside protection or buffer level of 20%. By using buffered growth notes in our portfolios, we're trying to get our clients access to the equity markets, but also have some protection. So that way, we're able to allow some clients who wouldn't actually participate in the market to get some growth upside because we do have that downside protection. So you can look in this particular situation, at the end of the 3-year period, the S&P was trading at 32%. Since we have 125% upside protection, we get 125% of that 32 return of the S&P, which is 40%. So in this particular instance, our clients would get 100% of their money back plus a 40% return, so 140% return. In the next instance, you can see the index was down 10%. We have a 20% downside protection, so our clients wouldn't make any money, but they would also get all of their principal back. If we would have been in the market and depended upon dividend reinvestment, they may have experienced a 10% downside loss in their equities. In the last example, you can see the market finished down 25% at the end of the 3-year period. We had the 20% downside protection or buffer on the initial investment. So at that point, because of the buffer, our clients would have lost the 5% of their money, the difference between the 20% buffer and the 25% negative return of the index. So if we'd have been in the market, again, depending on how dividends were treated, we could have experienced a 25% negative return. But in this particular instance, even though we did have a negative return, it was only negative 5%, so they got 95% of their full money back. So hopefully that was helpful to go through a couple of these illustrations.
Yeah, absolutely. So you took us through the details and the differences between a growth note and an income note. But what would you say would be the risk associated with these structured products?
Yeah, well, that's a really good question. There's primarily 3 risks when using notes. The first is issuer or credit risk, and that's the risk that in a crisis, the issuer of a note becomes insolvent. So think of JP Morgan or Goldman Sachs going under. So one of the first screens that we do when making sure that we consider what banks to use, we use only banks that have good credit ratings and low potential default risk. The next risk is market risk. Because the notes are linked to different indexes, this can cause volatility. We spend a great deal of time and research to come up with a combination of indexes that give our clients the greatest likelihood of success. And finally, there's the potential opportunity cost of holding the note. These investments are designed to be liquid. So there's a potential that they could underperform other investments over a set period of time. There's a secondary market for these notes, but an investor could receive less than they invested if they decide not to hold a note to maturity.
So I get all that. I guess my next question would be why? Like, why would we use structured products in today's market?
Again, that's a good question. Typically, portfolio managers have been able to rely on the 60-40 model, the balanced portfolio, the golden ratio between stocks and bonds that have allowed portfolio managers to have an upside opportunity while being able to dampen the downside exposure should we experience a market pullback. Well, unfortunately, during the last full few pullbacks, the global crisis, COVID-19, and years like 2022, we've started to see stocks and bonds move in the same direction. So we're not able to provide the same protection that we need when we have a pullback. Most of you remember 2022 when the stock market was down 19 to 20%, and the bond market was also down 14 to 15%. So there really was no place to hide. The structured notes that we have used give us some shelter from the storm of a downturn. And as I mentioned earlier, the higher the level of protection that we use with our notes, this gives us a tool to better protect the hard-earned assets our clients have grown over time. They have entrusted us with those assets, and our main goal is to try and get any positive return we can when we go through these periods of uncertainty and volatility. One of the questions that I get a lot and I like to address before we finish is pricing of notes that are on our client statement. Whenever you buy a note, you're going to buy it at $100 a share. The price will then start to fluctuate based upon the performance of the underliers tied to the index. Now, this price fluctuation in pricing allows us to get bought out of a note before maturity if we choose to. The duration of the notes that we use are typically between 3 and 5 years. So normally, they're going to have one of two outcomes. They will either be called because they are pricing for more than we paid, and typically in the industry that's between 8 months and a year, or they will mature. The primary value that we're worried about on your statements is the price of a note on the day it matures.
So I'm sure we are not the only ones out there that are doing structured products. So what would you say makes us different?
Well, I'm glad you asked the question so I have a chance to get you the full answer. I get this a lot, and the number one is the amount of time that we've been doing structured notes and in the way we typically use them. I know structured notes have been getting popular over the United States over the past 10 years, and I've been using them over the past 5 years or so. So what that lets us and our clients have is I have a great deal of experience when putting these notes together. I understand what risk levels I need to pay attention to and what underliers work best for the notes that we use. So what I'm able to do is recommend a note that's going to have less risk compared to some of the other indices. I've done a lot of back testing to determine what's going to be the best possible combination of indices to get our clients in a position where I'm trying to minimize the amount of risk that they're taking in each individual note. And does that mean that they're not going to breach a barrier? No, because there's never a 100% guarantee, but I'm trying to get as close to 100% guarantee that the note's not going to breach a barrier as I possibly can. The other big thing is I get pricing from different sources. I go out and get pricing from at least 2 or 3 times a week. And so by having that competition between different groups for the same amount of business on the same notes, I get pricing from different banks on the exact same note, and they could be anywhere from 0.5% to 1.5% difference in prices that I'm getting from all the other banks. And because I'm sourcing it with 2 different groups, I can compare the same note with one company to the same note with another company at the same bank and determine if there's a difference. And if there is, that means the third party is taking a bigger cut. So I'm not trying to make it where providers don't make any money on these things, but obviously everybody's got to make money. But the thing I'm trying to do is bring the best price and valuation to our clients that we can. And I think lastly, what I do is I've spent years developing relationships with these investment banks, the Goldman Sachs of the world, Bank of America, things like that. I go up at least once a year and have meetings with a lot of the different investment banks. So they get to know me and I get to know them. So whenever they see my pricing come across their desk, hopefully because of the relationships that we've developed, we're going to get better pricing from them. And lastly, and most importantly, we hold all these notes in managed accounts in fee-based accounts. So therefore, there's no commission on any of the notes. My main goal is to get the best possible pricing and coupon that I can from these different investment banks. This helps to put our clients in the best possible position to be successful. So that this, in a nutshell, are the different things that we do that can make a difference, and I think separates us from everybody else. So if you have any questions at any time, feel free to give me a call, and I can walk you through everything that we're watching. And believe me, we're looking at these every day. Our main objective is to make sure that we put our clients in the best position to be successful and to help them achieve their goals.
Yeah, absolutely. Todd, thank you. That was so helpful for just walking us through what structured products are utilized for and how they benefit our clients. Now, these talks are designed to bring you information and education. And in the past, you've asked if you can share this information with others who you feel would benefit from it and what we discussed today. And the answer is yes. You can share it with anyone you think it could bring some insight or education to. And if you are interested in going into more detail about anything we discussed today, or you have questions about the content discussed, you can contact our office or book some time with Todd, as he mentioned, to get on his calendar, or reach out to us and let us know how we at GenCrest can help in any way. Thank you again for joining us, and we look forward to talking to you soon.